David, I'm going to begin with you and go right to the heart of the matter. You say the market is still in a bubble. I want you to address that. But even more leaping off the page in my notes is your assertion that inflation is going to basically collapse and very quickly fall to 1.5% from where it is today, somewhere around 5 or 6.
Right. Well, I mean, the second point on inflation is pretty simple. We have a firming U.S. dollar. Nobody talks about what a constraint on domestic inflation that poses. And we're seeing the commodity complex, which really started the road on this inflationary situation we have. Commodities across a broad front have peaked out and rolled over. I mean, a lot of my thought process is based on my assumptions, but I've seen this run up, the cycle of goods-related inflation come and go in the past. This will come and go. People think supply chains will never get fixed again. I don't believe that for a second. And yeah, so I think that when you trace out what I think service sector inflation is going to do, and it'll remain close to a 13-year high, that'll be sticky. But the good side is going to come under pressure in the next 12 months. And the arithmetic will take you down well below 2%, and that's not priced into the market. And so, you know, that's the view on inflation. That's actually probably, you could argue, a bullish view as far as what it means for risk assets. My only complaint about, you know, risk assets in general, it's not just equities, it's corporate credit, it's residential real estate, is just the extent of the valuation. So look, we have a 40 CAPE multiple in the S&P 500, 40 CAPE multiple. It was in the 30s before COVID started. And interest rates, bond yields are almost the same now as they were then. The point I'm making is that only 2% of the time in the past century has the market been this elevated in terms of the real classic long duration price earnings multiple. It's a 3 standard deviation event. And for people that say, oh, well, but it can be justified by lower interest rates, well, that used to be true. At the multiple 10 points ago, you can justify that. But we did the work on it and found that even when you normalize the current interest rate climate on today's valuations, the S&P is still 15% above its intrinsic value.
All right, David, you've made a strong and eloquent case. Let's see what Stephanie Link thinks about it. Stephanie, do you want to push back on anything David just said?
Well, I'll push back a little bit. I mean, obviously, we have to watch the new COVID strain, any developments, international travel restrictions, state of emergencies, cases, hospitalizations. But the good news is we have medicines that exist. We have medicines that work, and more medicines that are coming. And we have high vaccination rates. 70% of the U.S., they're vaccinated. That compares to South Africa, 59% are not vaccinated. So we need more of the people to get vaccinated, and hopefully over time that will happen. But this comes against a backdrop which I actually think is a strong economy. I thought that the October data, and so far we're getting November data, is pretty good from the summer slowdown. And it's led by the consumer. Wages are up. Jobs are plentiful, and initial claims are at a 1969 low. Retail sales are above pre-pandemic levels. ISM services are at a record. So the consumer, which is 70% of our economy, is doing pretty good. Manufacturing, the ISMs and PMIs are above 50, and they have been for over a year now. And business investment is starting to pick up. And finally, on inflation, I think inflation actually is stickier than expected. If you look at wages and salaries, the average over the last 6 months, that's up 11.4%. That's the stickier part of inflation, and I think it's here to stay, in addition to rents that are up about 5% annualized. So I think growth is better, but inflation is higher, and I think the Fed can taper. We got to get through this new COVID strain, though.